Okay, so welcome to the fifth lecture of European integration. Today's topic is very exciting. It's about the role of trade in bringing about economic integration between regions. And there's no better example of this than the European Union, which was originally conceived in the 1950s as a customs union. The regional banding together of parts of the world to eliminate trade barriers within those regions and countries. And that's what the European idea was at the beginning. It was less about political unification than a movement towards the reduction or even the elimination of tariffs. So we're going to talk about the role of eliminating tariffs, and in particular the role of trade integration. It's not just about getting rid of tariffs, because we know that that can also that often, almost always leads to consumers being better off, but it's also an interesting issue to ask, or a question to ask: what is the efficient allocation of factors in various uses that could be changed through moving towards a regime of free trade? Okay, so today's lecture will first be an announcement. We're planning this excursion. Please pay close attention in the section. Dragos will make an announcement. It'll be in June, and it'll be a day trip, and it'll be on the day of one of these lectures. So it's really a great opportunity to go see what's going on in Poland in the context of this course. And we're working very hard to organize a couple of visits with companies so you can actually see and talk to people who are involved with these types of movements of capital and labor and the like. I'll review the last lecture as always, and then I'll try to give you some general thinking points about international trade, some general ideas before we get specific. This will be a highly technical lecture, although we won't use very much mathematics. We'll be using lots of diagrams, so I urge you all to go back into your microeconomics textbooks and your courses you've taken and review these concepts. They're extremely important. The reason we do economics is to use a way of thinking about the world, to encounter new questions and challenges, to think about new situations. And to do this, to think about international trade, we have to apply microeconomics. So trade is really about applied microeconomics. Even if you've taken a trade course, you might want to brush off these old tools, because they're all very relevant. And they're all pretty much common sense, but applying common sense is not as easy as it sounds. In particular, I'd talk about the following concepts in detail. What is an isoquant? What is a production possibilities frontier? And what are Isocost curves? And chances are many of you have not heard of all three of those. So it makes sense to think and listen very carefully to what I'm about to talk about. Using those basic tools, I'm going to talk about the regional integration of two regions, just as we've talked about Finland and Poland in this sort of very stylized sense. I'm going to talk about the trade integration of two regions in the sense of what would happen if those countries faced common prices for the goods they were selling, not necessarily in balanced trade with each other. We'll see in a second that that's not at all the European paradigm. We'll talk about the way firms react to a change in output prices, the way firms react to a change in factor prices. So when you open up two regions for trade, what happens is there'll be pressure on factor prices to converge for reasons that have nothing to do with migration, nothing to do with capital mobility, nothing to do with economic growth. And that's the interesting part about trade. We'll talk about that in a fair amount of detail. And that's going to be the factor price equalization theorem of Heckscher-Ohlin trade theory. Okay, so these are, as I said, fairly technical concepts, but have very graphical ways of thinking about them, and therefore there's no need to do a lot of math in this course. If you're interested in trade theory, do it as a master, and you can do all sorts of large systems of equations and think about this in the N region or N country case. It's all very interesting. The gains of trade are a very, very interesting set of questions. Whether countries always gain, can countries compensate each other, etc. We won't be getting into that in this course. Last time we talked about labor mobility as a driver of economic integration within Europe and in general. We talked about migration in theory. We motivated migration as primarily a response of individuals to seeking an improvement in their life by working under better conditions, labor conditions, but also, most importantly, wages. Okay, so wage differentials are an important driver in the macroeconomic sense, and we've seen that that was verified. We also talked about the microeconomic theory. It's not just moving at the drop of a hat. In other words, the differential is important, but it's not the whole story. Migration involves human costs. It involves upfront costs, and you can think of it as an investment, and investments have to be motivated by an amortization schedule or some plan to pay back those upfront costs. Otherwise, it's not worth it. So that's why we don't see as much migration as, sort of the first guess would suggest, because there are lots of unobservable and observable costs involved in migration. And we decided that there's even more, we discussed the fact that there's even more interesting aspects going on under the surface, because we can't observe, and probably will never observe, all the attributes of the migrants that do come. But we decided that those migrants are decidedly different from those who stay. And it's not just whether you're young versus old or have low costs versus high costs. It may have to do with your valuation or evaluation of your own chances in the receiving region of receiving a good job, getting a good job with a high paying, with a high wage. And that involves often information on your own motivation, information on your own skills that maybe the outside observer would not be able to see. So that was the so-called Roy model, and it's a very, very robust model for discussing many different aspects of human life and existence, not just the migration decision, but also the decision to choose an occupation. Why do you choose to be an economist? Well, it usually has something to do with your own personal motivation, not just because you randomly pick the occupation or the course of study out of a hat. The same is true of this migration decision. We finally looked at migration in practice and showed that there's quite a bit of movement in Europe, not as much as in the United States, but enough at the margin to make a difference. And especially after the accession of the Eastern European countries, a lot of marginal migration has occurred between places like Romania and Bulgaria and Poland, even outside the Eastern European EU regions, to places like the UK or Spain, and in the most recent period, even in Germany. These migration flows can have an effect on the wage, and we've observed the whole time that wage convergence has occurred. Consider the wage of Bulgaria, of a Bulgarian worker practically doubling in comparison to a German worker in the past 10 years. That's quite an improvement. And that's not just the fact that a lot of Bulgarians are just can't be found anymore in Bulgaria, but it's obviously also a function of the fact that there's been some foreign direct investment. So these are both, substitutes for each other. Today we're going to talk about trade, and the idea here would be that starting from point E, the endowment point between Finland and Poland, Poland being less capital intensive than Finland, that maybe trade in goods and services, when I say trade in goods, I also mean services, because services are an increasingly important part of flows of trade between two nations. I'm talking about the possibility that trade would eliminate the reason for migration in the first place. So this could actually make it possible to achieve all the efficiency that we want to achieve, meaning that wages in Poland and Germany, or between Finland and Poland, could converge to a common level within some band without necessitating migration of people or capital. That's what we'll focus on today. So this is an extremely interesting set of possibilities, and some of them go in the right direction, and some of them may actually go in the wrong direction. So I'll need a couple of lectures to talk about this. This is just to give you an example of how intra-EU trade flows have changed over the past, say, 10 or 15 years. So starting at the introduction of the euro, we've seen an increase in intra-EU, within EU integration of probably on the order of about 60 to 70%. Now you see there's a big dip that's associated with the financial crisis because a lot of what countries trade has to be financed, and if banks aren't functioning and able to extend loans to businesses and finance that trade, trade doesn't happen. So this is a very good explanation of why the German recession in 2008-9 was so severe. Even though the unemployment rate didn't rise, the fact is that output dropped by about 6 or 7% because a lot of what Germany does is export to the rest of the world. And if those exports of machines and cars can't be financed, then they're going to go down. But you see that we've basically recovered the previous level. This is data as of 2013 from the European Statistical Office. Just to show you how this breaks down, this is exports within EU countries, the EU in 2013 by country. So you can see that, and these are absolute levels. These are absolute levels, billions of euros. So you can see Germany and Netherlands are the top. And Netherlands is much smaller than Germany. So you have to understand Netherlands is really a trading country. Okay? And you can take it down to the other end. You can see the smaller countries obviously have smaller absolute amounts of trade. So this is a very important dimension. We should never talk lightly about leaving the euro of any country that's in the European Union or leaving the EU, because I think a lot of this trade would be at least called into question. You know that the United Kingdom just had an election. Conservative, the Tory government has an absolute majority, and they plan to pose a referendum to the rest of the United Kingdom to stay or to leave the European Union. Well, as you can see, the United Kingdom benefits in an export sense quite a bit from trade within the EU. And, you know, leaving the EU does not mean that this trade continues. It has to, the conditions, the external tariff and all the rest has to be negotiated, and there's no reason to expect automatically that the most favored trading status would be conferred to a country that just left a trading union. There'd be something that would have to be negotiated. This is just for your own benefit. This is to show the trend over time. And this is again in comparison the different countries. You can see there's been a real intensification of trade. There's been also an intensification or increase in trade, if you like, imbalances or deficits or surpluses within countries. So you can see that the situation lines up quite differently across countries. This is normal as long as it's sustainable, because if you run an export surplus, the supposition is someone has to be paying for that, and they either pay for it by exporting to you or taking up credit with you. So this is a common macroeconomic sense. This is really just to give you an example of how trade has become, on the sort of intensive margin, more and more intense, but not in an equal rate of change. So you can see countries that have actually done extremely well and others that have done less well. And I look at some of the southern European countries and see much less intensification of exports as opposed to some of the larger trading countries in the northern part of Europe. At the same time, it's important to control for the fact that trade across the world is increasing. And this is mostly because of the advent of China or the arrival of China and India and Brazil on the trading scene has made it profitable for countries all over the world to trade more outside their normal trading unions or customs unions. This is true of the United States as well, of the NAFTA, as well as it is for the European Union. But you can see there's been a drop of intra-EU trade in relation to the rest of the world, because the rest of the world has become more important. We're buying more stuff, more imports from China, and we're exporting more materials and products to China than we did 15 years ago. I'm going to speak in particular about bilateral relations within the European Union, because that's the most important part of this lecture. The lecture is supposed to talk about trade integration. So let me give you an example. The Polish German trade relationship is quite complicated. There's a lot going on, and there's a lot to be caught up for. During the time of the Iron Curtain, German-Polish trade was rather limited, but if you think about how close and how large those areas are, those regions are, and how many people live there, it would be a no-brainer to expect more trade. The benchmark would be French-German trade or German-Italian trade, looking from the German perspective. And it's interesting to see how in the past, say, 10 or 15 years, the intensity and the direction, the qualitative direction of trade has changed substantially. So the idea here in this table, the sequence of tables, is to basically break out the individual sectors and look at how things have changed. And you can see there are quite large swings in these trade flows. And these have nothing to do with the business cycle. These have to do with some sort of comparative advantage. Okay, so take meat processing, for example. Who would know, who would have known, who isn't familiar with this data, that the Germans run a very large deficit with Poland on meat? The meat that you get for breakfast or have on the table, the stuff you're grilling on the barbecue tonight, is probably coming from, given we're in Berlin, it's coming from the most obvious no-brainer place. It's not coming from Denmark, it's coming from Poland. Now, it should be said also that before you stop buying that stuff, you should keep buying it, because it's probably made, and it most certainly is made under EU standards, and that's why the Poles are in the EU. And it's also probably made with capital that's owned by people who are your neighbors, or maybe your bank, using your deposits to finance capital in Poland. So a lot of the trade that we're observing is a consequence of the increased capital mobility we've observed over the same period. And again, I always find most astonishing the milk and dairy sector. Okay, so the German surplus of 24 million euros in 1995 just disappeared, went into large deficit with Poland 10 years later. These are very large swings, and these swings can have very large effects on the wages and the rates of return of capital in those sectors. Okay, so you can imagine the milk and dairy sector in Poland is doing pretty well. It would be nice to have a job in that sector. You're probably making pretty good wages. You're probably very low unemployment rate. Okay, and you might say exactly the opposite for the person in a Brandenburg dairy or a Brandenburg, cheese factory, if there's such a thing. Okay, so these kind of switches, these kind of shifts, over 5 or 10 years are quite significant. Same thing is true for grain. You see other places where the Poles have actually lost market share, or actually moving into deficit with Germany. Pharmaceuticals, massive. Okay, so I can imagine a lot of what the Poles were making in the pharmaceutical sector has just become less profitable and has been closed down. The same is true of organic chemicals, maybe not so much in the inorganic chemical sector. I can't tell the story for that. But you can see similar stories in all sorts of sectors. Huge surplus with German plastic exports to Poland. On wood products, a big deficit. Clothes, it's known to us that most of the clothing sector, if it hasn't migrated to China, it's migrated to Poland, okay, or to Eastern Europe in general. And interestingly enough, the metal deficit has fallen. We have to know more about what's going on. You have to really get into the detail. The devil is in the detail in these cases. And a lot of this has to do with third countries. So trading with China. China may displace some of the traditional exports that Poland had, but traditional means in the past, say that it established itself in the period following unification or following the fall of the Berlin Wall, may have been swept away. And one of those might be clothing manufacture, textiles manufacture. We know that Poland has a traditionally strong textile sector, I guess in the Łódź region, but some of that has also been scaled back. And we know from economics that it doesn't necessarily mean that they're all producing the same stuff. Usually it's an upgrade, so what's left in Poland is probably higher value added than it was 10 years ago. Okay, so I'll let you think about that one. Again, very large swings. Everyone knows that furniture is made in Poland, right? Not all furniture, but IKEA had a presence there, and this has certainly been expanded. Automobiles, the Polish deficit has become larger. The German surplus in automobiles to Poland has increased. This shouldn't surprise you, given that a lot of Polish A lot of German automobile manufacture has moved to Eastern Germany, which is closer to Poland. Okay, so all these things that we know are important from trade theory. If you know any trade theory, we know that distance is important. We also know, more importantly, that factor endowments are important. So if you look carefully at these notes later, you'll notice that a lot of the sectors that have become have favored Germany in the sense of a larger surplus are those sectors that are more capital intensive. Okay, and those sectors that have deteriorated are the ones that are more labor intensive. This is good evidence for a certain type of trade theory. There are lots of reasons to trade with other regions, and we'll go through those in a second. But this is going to suggest that maybe factor endowments, like the ones we've discussed in the context of our Edgeworth diagram, this is a great way of explaining what's going on. Okay, so the next step would be to think hard about international trade. It's not obvious. Okay, you know, there's a consumer perspective, and the consumer's perspective should be actually the most important for us, because trade is about getting goods that are cheaper for given quality, and that should make us all better off. If you're a person who earns the minimum wage, you're going to be happy to be able to buy clothes at lower prices, to buy certain essentials at lower prices. High prices are bad. They're bad in general for everybody, but they're certainly better for those who earn low incomes. Okay, so trade should be a lighthouse for us in thinking about how to improve the real benefits of earning a certain amount of nominal euros, because this is important. So we want to be very critical about protecting inefficient industries just for the sake of protecting some people who have jobs at home, because the cost of that might be making it very difficult for a whole class of people to enjoy certain types of consumption. This is an important way of thinking about trade. It's not the only way, because clearly there are costs of reorganizing production at home. So if the cost of opening up the trade to Poland means losing the German clothing sector, some clothing workers will become unemployed in Germany, and they have to be somehow taken care of, either by the social welfare system, or they have to find another job in a different sector. That costs money. That money has to be raised. We have to raise taxes on other people, or maybe even put a value-added tax or a tax on the goods you're importing from Poland. So it's not an obvious. It's not obvious that this always is going to work out in benefit of the consumer. But it turns out that in the cases we're going to consider, there's a strong presumption that free trade is better. If you can compensate the losers, it's certainly better. First off, we're talking about voluntary trade. No one's forcing anyone to buy anything from Poland. No one's forcing them to buy anything from China. Now, presuming that the costs that are involved in producing those goods are correctly reflected in the prices, that is, there's no dumping, then this is the right thing to do. We should actually allow voluntary trade to take advantage of those gains to both sides. We talk about mutual gains from trade, at least for those who are actually doing the trading. To fix ideas, we're going to take a shortcut, and we're going to assume a full employment economy just to get started. And later on, in next week and the week after, we'll talk about the effects of unemployment and long-term unemployment on all the things I'm talking about. Okay, one has to remember that unemployed people have to eat as well. So the price level of goods for them is also important, right? The real command of their unemployment benefits or their access to the social welfare system is also important. But of course, if too many people are not working, then the economy will not be able to afford the system. So it's important to take that into account as well. So under these assumptions, the main mechanism for us in assessing the effects of trade will be the convergence of prices across regional boundaries. So again, thinking about what happens between Germany and Poland, is the price of milk in Germany moves down a little bit, and the price of milk in Poland may move up a little bit. Maybe it'll stay the same, it depends, but there's some sort of convergence of the two, and that price decrease is going to be a big benefit for the German consumer. The price increase for the Poles might be a disadvantage, but if Poland's also trading with other parts of the world, this means that Polish milk prices won't rise as much. And therefore, the benefit in terms of increased income for Poles will outweigh the disadvantages. So we're going to talk about that in some detail. And I'd like for you to think about this in the section discussion as well. This is something that a lot of people forget. I mean, you're bachelor students, you haven't been doing economics for very long. It's very easy to forget the fundamentals of what drive trade. It's about surplus. It's about the area under the demand curve, above the price. Okay? Producer surplus is the shadow side of this. So you also have producer surplus, which you may lose if prices go down. So we have to always balance these out. So let's start by thinking about voluntary trade. So we're talking about gains for both sides of those doing the trading. We're going to talk about this consumer surplus briefly. So I'm going to appeal directly to the book. Okay, so this is, by the way, this is a very nice quote by Albert Einstein. Everything should be made as simple as possible, but not simpler. And that's kind of the way economics works. And we have lots of fancy models, but the reason why they're fancy is not because we like fancy, it's because they help us understand, help us make predictions. Okay? So this is what I want you to remember. I want you to remember what a demand curve is about. Demand curve is supposed to measure how much the market wants to pay. Okay, so the slope of that curve is a good indicator of the distribution of the buying power and the willingness to pay in the economy. Okay? Now, obviously, it's based on some sort of exercise that involves doing the best you can. A lot of people don't like to talk about optimization these days. They say that we're too obsessed with Homo economicus. I think that's a bit over the top. It's usually a criticism by people who don't understand what we're doing. Okay? Because if you understand what we're doing, we're just saying people do the best they can given their circumstances. That may mean being influenced by other people. It may mean having wrong beliefs, but at least introspectively, I want to do the best I can. So this demand curve is nothing more than an aggregation of individuals' demands for the good given the price. Remember, this is an old idea of Hayek. The price is an aggregator, and if there is a market out there, we can see that price. That price is conveying information to us, and it's also allowing us to interact with that source of information. If we buy it, that means that our willingness to pay has exceeded the price, and if we decide not to buy it, it means that the price is too high. And this aggregation is supposed to be, and this is a very general curve. It's not just an individual's demand curve. A lot of times individuals only buy one. So we're aggregating over lots of people. And if you just aggregate their reservation price, the amount they're willing under which they would actually decide to buy, you get exactly the same curve. So the curve has two interpretations. It's the behavior of a representative person or a household, optimizing under a budget constraint, or it's the aggregation of many different people respecting their individuality and just ranking them. Okay, so if you have any statistics, you can think of this as some sort of like a cumulative distribution function. CDF from statistics. It's another way of thinking about a demand curve. Right? Just basically putting the people with high willingness to pay on the left and people with low willingness to pay on the right and ordering them. Okay, and even if people are different, even if you don't believe in the representative household as a metaphor, you can still believe in this, right? Okay. So getting back, the area under the curve above the price represents the excess willingness to pay with respect to that price. So the triangle underneath at P star, the triangle that starts at P star goes to the demand curve and goes up. That triangle is a measure of surplus to the market because the people who have very high willingness to pay are actually paying less than they'd be willing to pay, and they're getting it. It's like getting something for free. And the very guy, the guy or girl at the margin, P star, is just indifferent. Okay, so that's one measure of the gains from trade. You can see that if I can reduce P star a little bit, I'm going to make some people better off. I'm going to make everyone better off that was buying the good anyway. And then I'm going to bring some more people into the fold, sort of an extensive margin. A lot of people don't teach economics this way, but this is the most basic, robust version of the demand curve you can get. I don't have to make many preference assumptions. I can assume that people are buying one unit of the good or many units of the good. All I have to do is know what the market says. Okay? You need to have some way of assessing that. You can even use econometrics to assess that. The supply curve is a similar concept, except you have to think about the supplier. Someone is actually producing the good, and that's not necessarily the people who are demanding the good. So think hard about that. That's the whole point of why trade is so controversial, because the people who gain from trade are not the same people who lose from trade. But clearly, you can take the same story to the market. The supply curve is nothing but the behavior of a representative firm, or it's the aggregation of many, many, many firms with possibly different costs of producing. And those costs of producing are at the margin. If fixed costs can't be changed, the firm will always compare the price with marginal cost. If price is greater than marginal cost, the firm will supply to the market, otherwise not. So an aggregation of you like, individual sellers could also be depicted as an upward sloping marginal cost curve, or an upward sloping curve incorporating the reservation price, selling price of producers. So think of this as equivalently as an aggregation. So you can think of consumer surplus. If you can think about consumer surplus, then you should be able to think about producer surplus. It's the area above the marginal cost curve, or the supply curve, beneath the price. Okay, so you think about it, starting up here, this triangle to MC double prime down to the base to the intersection. Again, this intersection doesn't have to happen. If you're, we can think of all sorts of approximation measures, and then moving back. That triangle represents the benefit to the sellers of having that high price at MC double prime. At P star, that surplus goes down. Okay, so the area above the marginal cost curve up to P star represents the benefit to the producer because their marginal cost was lower, and it's like it's a surplus to them. If prices fall because of trade, that surplus goes away. Those guys are going to lose from free trade. Okay, so basically, the difference between those two is going to be changing. And when we track and next week I'll do this in detail, I'm just going to give you a little bit of taste for this. We're looking at the net gain from a region from a change in the price to consumers and to producers. What is the net benefit going to be? Okay, and that's a very important point. Obviously, the distribution of that benefit will matter, but it's an important point that surplus will increase as a result of trade, and we'll get to that. We'll get back to that later. Okay, so we've basically discussed producer surplus, possible risk of losing producer surplus through trade, and an increase in consumer surplus. Okay, and if you don't believe that, just think of all the electronic items you're able to buy now because Korea and Taiwan and now China are producing on the world market very cheaply. Okay, so we're all benefiting from that. And obviously, there are a lot of companies in Germany that have lost market share or have disappeared. You know, that's the shadow side. I'm going to be focusing on sustainable patterns of trade. And this means, in a sense, we always have to think, what does a sustainable pattern mean? Sustainable means that if a country is intentionally producing at below marginal cost, this is not going to be a sustainable pattern, a sustainable policy, nor is it going to be possible for a country to run deficits for a long, long time. So for the moment, I'm going to basically sweep away a lot of those questions because we don't have a complete model. And if Germany runs a deficit with Poland in dairy products, it has to be paying for that somehow. Okay, balanced trade would mean that it's paying for it by exporting more chemicals to Poland, or it's borrowing from Poland, but that borrowing may not be sustainable. Okay, so keep all these things in the back of your mind. We will basically assume that overall balance of trade is holding. So we're not going to look at these individual regional imbalances in great detail, but you should be aware that in macroeconomics, this is a big issue. So if Greece decides to run a deficit in every sector, including tourism, then it's going to have a problem. It's going to have to find some lender to finance that, and if it doesn't, it's going to be an unsustainable pattern. Let me discuss the three important types of international trade. There's a lot of discussion at the frontier of research now. There are new types of trade theory. I'm not going to talk about them. They're very, very interesting. In fact, some of them are very relevant for this course, but for a bachelor course, we're not going to talk about this. Okay, so if you want to talk about that, come to me, talk to me in office hours about it. So the first type of trade is Ricardian trade, comparative advantage. Who remembers what that is? Yeah.
Well, it's, as you put down, it's about comparative advantage when a country has an advantage, not necessarily an absolute advantage over another country, then that country should focus on producing that good when it has a relative advantage over the other country. So each country should focus on the goods where it is better relatively than any other country.
Okay, this is one reason why it's great to study economics, because most of us understand that. Okay, it's hard to convince other people, but you just have to work at it. Okay, and the idea is simple. Okay, for the rest of this lecture, we're going to be talking about two goods. We're going to talk about cars, autos, and then we'll talk about cloth, stuff. Okay, now imagine a world where that's it. Okay, everything else is we're just trading autos and stuff. Now suppose we're dealing with India. And the fact is, Germany is more efficient in autos, and it's also more efficient in stuff. Now, should Germany just not trade with India? Well, the answer is, it should trade with India. Germany should export cars, and India should export stuff to Germany. And it's very easy to show this. It just means you're basically, to neglect the fact that you have a relative advantage, okay, and the relative rate of transformation between stuff and cars is more favorable in Germany than it is in India. It would make sense for the Indians to produce the thing which they're more productive at the marginal rate of transformation. So they produce more. They can produce more units of cloth for 1 unit of car, and they should just move their resources into that sector and export cloth to Germany for cars. Okay, we'll show that in detail in a second. This is common sense, but people don't get it. But it's the reason we have specialization, and the reason why we should get it is because it's happening. People specialize. I could be a better programmer than some of my research assistants, but why should I do that? I've got to spend enough time doing this, preparing lectures, and my research assistants are not very good at teaching this course, right? So there's a comparative advantage. This is an important driver. Unfortunately, this does not drive the kind of convergence we're talking about. Okay, so you should take a note of that. This is not going to help us in terms of enforcing regional convergence. It's not going to have a natural reason to push German wages down and Polish wages up, or Finnish wages down and Polish wages up, or rates of return on capital. These kind of models were based on the Ricardian concept that it costs to make a unit of stuff. It requires, say, 3 units of labor and 2 units of capital. So what Leontiev called a fixed proportions production function. You can even draw that. You can write down that model with a single factor. Okay, it's all about relative productivities. And in the section, you'll go into a detailed example of that, just to make sure you understand it. Based on productivity differences. Okay, so you can tell that story. It's an obvious exam question. If you can't get that, you don't really deserve to be called an economist. Seriously. That's something that makes us special. We understand that, Okay? Now, it's about comparative advantage. It's not about it. And then you also wonder, well, why do countries want to export everything? Is Germany kind of got it wrong? Right? Germany's trying to export everything. Well, that's not true. We saw already that Germany has given up very large segments of very important manufacturing sectors to other countries. Germany has ceded the dairy industry to Poland or to other countries, perhaps in the region. At the same time, it's tended to grab more of the pharmaceutical output. So, I think the world does get it. We just have to be able to get it and tell other people about it. It's certainly relevant for trade with the developing world, okay? Because, again, the Indian example is a great example, or a Chinese example. I'm going to focus more on hexro-lean trade in this course. This is a course that's about regional integration of countries that have similar production functions, similar production technologies, and we've kind of made that as a backdrop. So there's no reason to think that the level of total factor productivity in Poland and Germany should differ by that much. In fact, joining the EU requires that Poland adopt European standards. Okay, so it's impossible for the Poles just to pollute their environment and get away with it by cut prices and sell this stuff cheaply into Germany. That's ruled out by the European Union, effectively. There may be some exceptions, but in the principle is convergence of standards means a convergence to and getting rid of corruption, for example, generally agreed standards of rule of law mean that basically the total factor productivity will move more closely together. So we can basically assume that the production technology you need to produce plastic in Germany is the same one you would use to produce plastic in Poland. And if that's the case, then what's going to matter is you're going to export goods, you're going to tend to export goods that involve intensive production of the factor that you have more abundantly endowed in your economy. So if you're a capital-intensive region, you're going to tend to export those goods that are capital-intensive in nature. That's a really important idea. It's not the same thing as comparative advantage. It has a similar flavor to it because it is about relative difference, and you trade on the difference. But it's based on two different production functions with at least two different goods, and the fact that under constant returns and the same technology across countries, you're going to have a relative specialization in producing that good that uses your factors that you have in your endowment in relative abundance. Okay. So the last type of trade is extremely interesting, but again, not one that's going to help us very much. Okay, so this is the idea that about 40 to 50% of the trade observed between Germany and France, and Germany and a lot of other countries, has nothing to do with either comparative advantage or with factor abundance. It has to do with the fact that people like variety. Okay, so a lot of people in this country buy French beer. Sounds like a strange thing to do, given that the Germans are kind of the Weltmeister in beer production. Maybe the Czechs are better. Okay, but it's a fact. And this is a very sustainable trade pattern. French, import German cheese. Why would they do that? They make the best cheese in the world, arguably. But there are obviously some people in France that slightly disagree. They want to have some product variety. Germans import French cars. It also seems like a strange thing to do, but it's just proof of the fact that products are differentiated. People like variety. People like to be different. And because of that, there's intra-industry trade. So it will never be the case that the Poles stop exporting plastic to Germany. There'll be some variety in either the input, which is what we're talking about, inputs, or the outputs that are valued in Germany and give rise to trade. I'm not talking about this kind of trade either, although it's very important. So we're going to focus on the second one, the hexro-lean problem. Okay? So to do that, we need to get some assumptions on the table. We're going to talk about factor proportions trade because it's basically trading on relative factor differences, the factor differences that make a difference between East Germany and West Germany in 1990. They made a difference between Poland and Germany in 2004, and make a difference between Germany and the Ukraine right now. Right? There's a big difference in capital-labor ratios in terms of endowments in those regions. And okay, so we're going to talk about a 2x2x2 case. Two factors of production, obviously, capital and labor. Two distinct goods, Stoff and Autos. Okay? Stoff is cloth, Autos, cars. Two regions. And we're not going to focus on balanced trade, so we're going to assume that the world price of autos and stuff is exogenous. It's given to us by the outside. So there's a world market for cars. If the Germans can't sell their cars in the other region, then they'll just sell them on the world market. There's a world price out there. That's an important simplifying assumption for us. Believe me, international trade theory is very difficult. It involves general equilibrium at a very high level, because you're talking about general equilibrium that involves multi-factors, multi-products, households, possibly heterogeneous households across regions. It's rather difficult to do. And we're doing this diagrammatically. Very little mathematics today. We're going to maintain the assumption of constant returns to scale. You should all know what that means. It means that the capital-labor ratio is a sufficient statistic. And because they have a common production function, that means that that is going to give an indication of labor productivity. It's a sufficient indicator of labor productivity. So we're talking about two production technologies. One is capital-intensive. That's going to be autos. And Stoff is going to be labor-intensive. Okay? And I'll make that very clear in a second, diagrammatically what that means. So we're talking about a regular regional economy. If you have increasing returns to scale, things get very complicated. And it's a nice exam question, but we're not going to do it right now. So we're going to assume perfect competition and small country. The regions are small in the world economy, prices are given. Most important concept you'll talk about today is this integrated equilibrium. So I'm going to talk about the response of the local regional economies to these world prices and the implied factor prices as a result of trade. Okay, so the trade equilibrium implies that the price of cars and cloth in the two regions are the same. It doesn't make sense to go to Poland to get, I mean, if you wanted, you could buy the cloth in Germany, you could buy the cars in Poland, the price is the same because of the integrated equilibrium. Okay, so arbitrage makes sure that, of course, there's a band. When we go to Poland, we get on that bus, we're going to decide on what goods we're going to look for. And this is a fun game that I always play whenever I travel. And I want everyone to have a good to write down. Don't let me forget to do this. You're going to go out and do a little market research. One of you will get the price of a pocket knife. The other will get a cost of 500 grams of coffee and the cost of a roll, Brötchen, and we'll compare them in Berlin and in Szczecin. And you'll see that traded goods are very close. A pound of coffee in Germany is the same up to a value-added tax margin, even not even, because there's some play involved there in the two places. Okay, we want to verify that because traded goods can be moved easily. It's not the case with Brötchen. It's not the case with haircuts. There are large differences. Rents, the cost of renting an apartment in Poland still is much lower than it is even in East Germany, although that's changing now over time. Okay, it has to do with all sorts of things we'll talk about. So integrated equilibrium means the traded good prices are converged. They have converged to the same. Okay, so let's go back to our concepts. Now, I know a lot of you people know this stuff. You think you've seen it before. I urge you to look at it again because we're going to look at it with a bit of subtlety that you may not have seen before. Okay, so we're going to talk about isoquants. Isoquants are a way of summarizing compactly, graphically, production technologies. Okay, and we're going to talk about the implied production possibilities frontier that describes the menu of possible outputs that a country or a region can produce under those production functions. Okay, so these are technological and not market-oriented concepts. They have nothing to do with markets. You argue that the production possibilities frontier can be written for a market economy or for a planned economy. That's true. Okay, and those are you like to think subtly about these things. It's certainly possible, but technically, a social planner can draw a production possibilities frontier as well as at least on paper, to describe what a country can do, whether it produces all of one good, all of the other, or some mix of the two. Okay, under constant returns with the given factor endowment, so Poland can't import people, Germany can't import people, as a first approximation. We're not even going to let people move between the two regions. We're going to talk about the limitation of fixed factor endowments. That's the whole objective of today's lecture. Okay, I'm going to talk about Isocost curves, and I'll define these again, but this is something you certainly haven't seen very often. This is describing basically, under constant returns to scale, the factor combinations that are possible, and again, we just have capital and labor. What factor price combinations can I pay to my factors and exhaust the profit, or exhaust all the excess profit, so you have zero economic profits, given the world prices for the goods? Okay, so it's going to look a little bit like an isoquant, but it's not. It's tracing out the combination of the wage and the rental rate of capital, the rate of return for capital, that are possible at given world prices. So it solves like an optimization problem also. It's like the firm's cost minimization problem, or as we'll see later, it can be described in a slightly different way. The more important thing is zero economic profits. That means that what labor doesn't get paid goes into the return to capital, and it exhausts it in the sense that the marginal product of capital times its input will equal its payment. Okay, that's a defining characteristic of zero economic profits when you have constant returns to scale. Okay, so let's start with isoquants. Here's the picture of a classic isoquant, and we're going to talk about stuff. Okay, so think about this as summarizing the infinitely different combinations of capital and labor that are necessary to produce a certain quantity of the good in question. Here we're talking about stuff, so obviously QS1 is less than QS2 is less than QS3. So think about this as think about QS1 as producing this quantity QS1 of stuff in different combinations. So this would be using a lot of capital and a lot less labor, and here I can substitute by using a lot of labor and very little capital. Okay, so we're assuming basically sort of the putty and not the clay part of technology. After you've taken the decision, these trade-offs become a lot more difficult. Okay, so you've built the factory, it may be difficult to do the substitution, but for an economy as a whole, it's still a valid description, because every economy can get rid of the production that looks a bit strange or a little bit less efficient and move into the other. There's a margin of substitution. Okay, so think of this as the ex-ante choice of production technology. All right, so QS2 would correspond, strictly speaking, to producing a higher quantity, a larger quantity of stuff compared with QS1, and QS3 would be a larger quantity. So you definitely need more production factors, but you can substitute. Okay, you can substitute, and that's the curvature of the isoquant. These are very important because we can use them to summarize the production function. It is literally setting the production function f of k and l equals some quantity, and then asking what is the variation of q and s. And of course, as you know, the variability that's possible is due to the elasticity of substitution. It's the rate at which the marginal rate of substitution changes when I change the capital labor intensity. Okay? So we can think of a high degree of substitutability would be like almost a straight line isoquant, and very little substitutability would look like an L. Think of Leontief, L, okay, like this. All right? That's going to give you the trade-off possibilities. In the limit, there may not be any trade-off at all. That was the production technology that Karl Marx had in his head. Okay, that to produce 1,000 widgets, you need 10 units of capital and 500 units of labor. And if you want to produce more widgets, you need more of both. That's the limitational, or German limitationale Produktionsfunktion, Leontief. Okay? L, Leontief, Limitation. Okay? So now I'm going to put two different sectors together now. This one gets a little bit complicated. So we'll think of Stoff and Autos. Now, Autos, they look a little different. And I've drawn this because autos are capital intensive. Now, how do I know that? How would I know that capital intensity of automobile production, the blue Isoquants, is higher than in the Stoffproduktion, in the production of cloth.
Because when I increase the quantity of automobiles, it rather moves toward capital intensity. So yes, the curve for Stoff rather moves to labor intensity, and when I increase the quantity, while yes, for autos it rather moves towards yes, the north.
Well, that sounds like you're in the right direction, but there's a very, very crisp way of doing this. Okay, I'm going to show you. Suppose I give companies in those two sectors the same ratio of wages to profits, to the return to capital. Okay, you can choose the tangency point. The tangency point would describe the cost minimizing choice for the companies that are using those technologies. Okay, so you give them the same wage and the same rental rate of capital. The capital intensive sector is going to choose a higher K to L ratio, a steeper set of points. So if you look at these points, this tangency, and this tangency, it corresponds to a steeper capital labor ratio than in the Stoff production, the cloth production, which would be down here. Okay? So that's a crisp way of saying what you wanted to say. And in fact, you can even say it without making an appeal to factor prices. Those of you who remember your production theory, you don't even need to know the ratio of wage to rental rate. You can talk about the marginal rate of substitution. For a common marginal rate of substitution between capital and labor, the capital intensive sector will use capital at a higher rate, okay? The slope of the ray that connects the tangency points of common marginal rates of substitution will be steeper, okay? So that's precisely what I'm going to mean, okay? But in the market context, if there's a common wage, there's a common rental rate of capital, which is what we're assuming. We have an integrated economy. Then basically those companies that are capital intensive will choose to use more capital than labor. It's a choice, right? But it's also a production fact. It's a fact about production technology. All right? So that's the way of looking at it. Look at those rays. Now, the way I drew those isoquants is that they are homothetic. That means that if I move the capital labor ratio, if I move along points of a common capital labor ratio, they're going to correspond to tangency points with the same marginal rate of substitution, or respectively the same wage rental ratio. Homothetic means as I move away from the origin with a common slope, I get a ray, a straight line from the origin. The capital labor ratio doesn't change. It's independent of whether I use a lot or a little capital, okay? At a common marginal rate of substitution or marginal or ratio of factor prices. It's a very important assumption. It may not be the case. You might have non-homothetic production. You might have fixed costs. There are all sorts of bells and whistles you can add, but this is a fairly good assumption given the aggregation we're talking about. We're talking about the Stoff sector, all the cloth you can imagine being produced. We're aggregating it together, and we're looking at the aggregation of all the car production. So this is a fairly good first assumption. The next concept I want to drive into your heads is the production possibilities frontier. This is even more interesting. So you can think of the social planner. We used to have one of those in the German Democratic Republic, like the planning commission deciding how much to produce, no markets, just produce and sell it to the people. If they don't buy it, it's no problem. You can think of the social planner as deciding maximize QA subject to the constraint that I have to produce some quantity of QS, and then vary QS across the possible ranges. Now, how do I do that? I have to reallocate labor and capital between these two production functions that I've written down. And as I do so, I'm going to move into the region of diminishing marginal returns in the capital intensive, beziehungsweise respectively the cloth intensive sector. And that's why we have this bowed out form, this convex shape to the concave shape to the origin. forming sort of a convex set. So think of this set as being a convex set, no linear combination of any points in that set are outside the set. Okay? Very important idea. So this is basically the best the economy can do, and we hope the market economy can achieve that, and under certain conditions it will. And we're just basically going to, in a full employment economy, we'll be on the edge of that production possibilities frontier. Now, a lot of this is very abstract to a lot of people. A lot of people don't love international trade, have some problems sort of getting warm. So I think it's easier to motivate this, which I'll do in a second, by thinking about what's going on. But think about this. If I move from producing 1 unit less of stuff and producing 1 unit more of cars, I have to free up labor and capital to do that, but I have to do it in a less than optimal way, given what I was doing before. Okay? Now, at the same time, we've got the question of choice. How does an economy choose what quantity of stuff and autos to produce? Well, the classic way of thinking about this is that there's a world market out there, and there's a world relative price vector of cars and cloth, and the price of cars of cloth to the ratio of price of cars will somehow give the incentives for producers to trade off between cars and cloth. At the same time, those indifference curves that you see up there, these indifference curves are denoting the tastes of consumers. So consumers don't want to produce or consume only cars or only cloth. They want to consume some mixture of the two. Okay? So the world economic equilibrium, you might think of, if this is the world's production possibilities frontier, would basically choose a price that would equate the marginal rate of substitution of cars, stuff for cars, with the marginal rate of transformation, which is given by the slope of the production possibilities frontier. That's one way of pinning down the equilibrium in the world economy. That's going to be in the background. We're not going to go into too much detail, but in the background, I'm going to assume that the price vector, and that's nothing but the slope of this, the ratio of cloth prices to auto prices, is going to be exactly that relative price vector that determines what regions do. Okay? Let's try to derive a PPF in a very simple case. So I'm going to take the Leontiev-Karl Marx production function. Okay, so if you remember what that is, it's in the right-hand side of that box. It says basically I can describe completely the production function by asking how many units of labor do I need to produce a unit of autos. All I need to know is QA, it's the quantity of cars, multiplied by the fixed coefficient. ALA is a fixed coefficient. Gives me the amount of labor I need. How much capital do I need to produce those cars? I need AKA. That's not the way the world necessarily works, and certainly doesn't work in the long run, but it's a good way to start, and it's the way a lot of people who don't know a lot of economics think about this. A lot of engineers think about economics this way. But this is a technology, and there's no reason to think that the K, AK, KA, or ALA are constant. They probably respond to incentives. They respond to prices. In this model, they don't, in this formulation of production. Similarly, LS would be the product of the labor coefficient, ALS, times the quantity of stuff, cloth, QS, and KS would be the product of AKS with QS. So those 4 equations give me the factor requirements I need to produce this stuff, and I cannot produce it without. So obviously, an economy that's endowed with an amount of capital, K bar, and a certain amount of labor, L bar, like we have in our model, has to choose where to allocate the 2 factors. And those 2 lines that I've drawn basically are simply the lines that describe the quantities that could be produced, okay, using the labor allocation. That's the L bar line, that's the upper one, the full employment condition for labor, and the full employment condition for capital is the other one. It's the one that's flatter. And the fact of the matter is, if you try to produce too much of the car, you're not going to have enough capital to do that. You're going to run out of capital. Similarly, if you want to produce lots of stuff, you're going to run out of labor. And that just goes from staring really hard at these two full employment conditions, right? They're just basically showing what could I produce if I only needed the labor, and what could I produce if I only needed the capital, given that I'm producing some of the other stuff. And I've drawn these lines basically as a function of QS. To make QS the independent variable, you could flip it on its head and make it a function of car production as well. So it turns out that the only feasible part of this set of possibilities is the red line. Okay, so it's the lower envelope, if you like, of the two full employment conditions for the respective factors. Now this assumption, this production function doesn't assume any substitution possibilities. So the only way you're going to get full employment in this economy is to produce at the green dot. The green dot is the solution of these two linear equations as a system. That dot will give us full employment. There'll be enough capital demanded and enough labor demanded to exactly exhaust the output of the exhaust the factor endowments that we have. Okay, so convince yourself that these patterns are the right ones to look at. Okay, because it's important to grasp this model. Because the next step would be to ask, what happens if I mean, you have to understand this green dot will be, in a full employment economy, will be the production output of the economy, assuming no substitution. It's a pretty sad situation, because if you're over here, or if you're over here, if you're in either of these two areas, you're going to have unemployment. You can have unused factors, unused capital, or unused labor. Okay? We can imagine what would happen if there were a shift of one of the factors. Okay, so this is an interesting question. What would happen if Germany suddenly had an increase in the allocation of capital? Okay, so this would be an increase in the allocation of capital. Could be due to capital mobility, could be literally capital mobility. We're just going to assume the instance of just a helicopter drop. So Germany just receives a bunch of capital. Now, what happens as a result? The flat line, which describes full employment in the capital sector, moves out. The only relevant production possibilities are the red ones. So you can see that the full employment outcome for Germany would be an increase in the production of the good that uses its more abundant factor more intensively, and that would be capital. This is called the Rybczynski theorem. Those of you who take trade theory or have taken it will probably know a more complicated version. We'll talk about that in a second. It basically means that a shift in the endowment, and this will also give us a prediction on what regions are going to produce what. An increase in the endowment of the factor will induce an increase, an absolute increase in the production of the good that uses that factor more intensely. The more interesting thing to look at is what happens to the other output. The other output goes down. Okay, so it's not just that you get an increase of both, you actually get a decrease of the other one. It's sort of like a crowding out of the other production, because to increase car production in Germany in this case, you'd need to actually get some labor from the other sector. So you're going to have to shut down some of the other sector to free up the resources to get the full employment condition to be met again. Okay? So the key thing, of course, is the factor intensity assumption, which I implicitly assumed in the back without spending a whole lot of time thinking about it, but that's exactly what's embodied in the relative slopes of these two lines. The capital-intensive line is flatter than the labor-intensive line. Okay? So you can think of a general case. The general case would involve a case where we have this world price vector, which is this blue line, and now you have a shift of the production possibilities frontier in a case where you have substitution. Okay, factor substitution is allowed. Okay, so you can see, first off, we don't have a funny-looking PPF that's got a kink in it, and the kink is always full employment. Now we have basically full employment allowed at all sorts of different price vectors. You just have to have the right price vector. Okay, so the idea would be that holding the price vector constant, an increase in the capital endowment of a country would increase absolutely the output of the capital-intensive good, the good that uses capital more intensively, and would reduce the output of the sector that uses capital less intensively. So this is a robust prediction. The key assumption is that the price of the output stays constant. And if those of you really like trade theory and you go on to think about this, you know there's a general equilibrium. So if there's a huge increase in capital, it might change relative prices of goods. You might have feedback in general equilibrium, and you have to worry about that. But since we're looking at a regional case, we can assume that the price vector, the blue line, the ratio of the price of Stoff to Autos is going to be constant as a first approximation. And that makes sense, doesn't it? I mean, if the Poles can't sell their stuff to Germany, they can just sell it to some other country. That's the assumption. So now we'll talk about something you probably have not seen. This is the Isocost curve, and this is the unit Isocost curve. So you can think of this as, just as we thought of the Isoquant as solving a input minimization problem. Produce quantity Y using minimum K, given that I have to use L, and then just varying L. You can do the same exercise in the cost space. Factor cost space, so wage versus capital rental. This is an important device for thinking about who gets the money. People in Germany are very concerned about distribution. This is one way of understanding it, because part of the distribution of income is between capital and labor. The other type of distributional issue is between workers who get paid well and workers who don't get paid well. So I'm focusing now on the so-called functional distribution of income. Okay? So you can think about this Isocost curve as solving a similar problem. A company that would actually minimize the cost of producing 1 unit of output and distributing the proceeds to either capital or labor. Okay, so cost minimization, it's going to be on its PP, it's going to be on its isoquant, it's going to be on some isoquant corresponding to that isoquant. The dual of that will be this picture. Okay, so moving along that line traces out different combinations of wage and profit that correspond to efficient production at a given output price. Here the output price is set equal to 1. We'll let the price change. Okay, so this is something you'll do in the section as well. It's a very important exercise next week. But holding the price of the output equal to 1, we can trace through basically combinations of wage and profit. You can see it's a distribution issue. Okay, so this is kind of Karl Marx, right? If the firms get high profits, the workers don't get much wage, and vice versa. Okay, and this is basically coming from if you like, a market-based concept. It's kind of common sense. If you can only sell a good for price 1, then you basically try to produce that good at the minimum cost, and I pay my workers wage W. How much can I pay the other factor, K? And you can turn it on its head. So it's basically the solution of a very simple minimization problem. First order conditions look like cost minimization and feel like cost minimization. They are cost minimization. This is a plot for price of the output being set to 1, but you can think if price is greater than 1, that means that basically both factors can actually benefit more. So price greater than 1 would imply shifting out the unit Isocost curve, because holding the rate of profit constant, you can pay workers more, or holding the wage constant, you can pay capital more. Okay, so price changes change the surplus that can be, or the payable surplus that can be paid out to the two factors. So there's a nice duality here that you should be aware of. We already saw that the ratio, the capital labor ratio in the isoquant curve intersects the isoquant at a point, and that point, the tangency of that point is called the marginal rate of substitution. Okay, well, the dual of that from the cost perspective is exactly the same. The slope of the Isocost curve can be shown to be the capital labor ratio at the point. Okay, so if you just imagine moving upwards and to the left in this diagram from here to here, we have a higher wage and a lower profit rate or compensation to capital, that would imply a high K over L, which means that capital is being used more intensively and probably exhausting its returns at the margin, and wages will be higher, justified by the fact that fewer workers are employed. So, you know, a great example, last 2 years ago or 3 years ago, we went to this factory in Schwedt, and this factory was producing all the recycled paper that's used for the Der Spiegel. I don't know if they're still buying it from them, but they were buying all this recycled paper. The factory had 20 people working there. This factory was worth 500 million euros. It was a huge factory. I'm exaggerating a little bit. Hugely expensive factory. So the K over L there was very high, and those workers were earning West German wages. Okay? So this is kind of showing you in a sort of a very clear example how this can be rationalized in a sense. Give the workers enough capital to work with, they can generate the productivity that pays their wages. Okay, so now why am I doing this? Why is the Isocost curve, the unit Isocost curve, so important? Because the unit Isocost curve is going to help us understand why opening up Poland and Germany and Finland to free trade, convergence of prices means convergence of factor prices. This is called the factor price equalization theorem. Okay, so the first part of the logic is you get rid of the tariffs, you open up to free trade, the Germans don't get impeded by the Poles don't get impeded by the Germans, the prices converge, the price of a bottle of beer in Poland is the same as a bottle of beer. By the way, it's true. It's pretty much true. I mean, when I go to the gas station and look at Polish beer bottles, they're not that much cheaper than the German stuff. There's probably a quality differential. So this is the kind of convergence I'm talking about. For comparable quality, the price is the same. Otherwise, you're making a big mistake as a producer. You should be selling into the expensive market. So once you get that, once you get all the price differential out, convergence of goods prices causes factor prices to converge. That's called the factor price equalization theorem. So in the background, I'm going to assume, getting rid of the customs, getting rid of the non-tariff barriers. That includes regulation. So the Germans might have the Reinheitsgebot for beer. The Polish don't have to deal with that because they can sell their beer into Germany even though it's not brewed according to the Reinheitsgebot. Actually, most Polish beer is brewed according to the Reinheitsgebot. Eliminating currency risk and all that kind of stuff will cause factor goods prices to converge, and that will imply factor price convergence. So I'm going to take you through the logic, and then I'm going to show you the diagram. Because the diagram is actually the reason we learn the diagram. But if you have to explain it to your grandmother, you got to be able to explain it in words. Right? So this is the logic of the factor price equalization theorem. Goods market integration forces price integration, price convergence. Traded goods. Obviously, we're only talking about traded output. At the same time, within a region, we have labor mobility. Okay, so to have labor mobility means that, or also capital mobility, not moving across regions, but within the region means that factor prices within a region are going to converge. So all we need for this result to hold is that the wage for a Polish worker in the car sector in Poland is going to get the same wage as that worker working in the textile sector. And they don't have to be equal. You can have skill adjustments, but what has to be true is that the skill-adjusted wages have to be the same. Okay, and that's going to be the basis for our formula. The same is true for the rate of return on capital. That's going to happen. It's going to basically mean that the two Isocost curves intersect. And when they intersect, that means that we have a common wage and capital return vector in that region. Okay? And if that's the case, and if they do intersect, that means that there's a common price for both, and there's not an excess supply or a demand of labor or capital in the region, and we'll be able to use that price, that intersection point, to describe the capital-labor ratios and the allocations in both of those sectors. Okay, so here's the key diagram. This is the intersection of those two Isocost curves. Remember, each sector Autos have a different production technology. Autos more capital intensive, okay, which implies that at a common wage rental constellation, the slope of the capital intensive sector will be higher than of the non-capital sector. So if you look here, you can almost predict this is going to be the car sector, and this is going to be the labor-intensive sector. Okay, so we have those. That defines basically the ratios at which labor and capital will be used in the two sectors, and the rest is just solving a simultaneous system of two equations. How can we exhaust the allocation of capital and labor in that region using those two implied capital labor ratios? Now that sounds a bit complicated, but the market will solve that because the market will always move the wage if there's excess supply of labor, excess demand of labor in the right direction. If there's excess supply of labor, the wage will fall. If there's excess demand for labor, the wage will rise. And therefore, we'll have a common wage rental ratio, and capital mobility is the same. So Polish companies that are doing badly in the car sector will shut down, free the capital, and move into the car sector until we have full employment. So we can translate those implicit capital labor ratios into the Edgeworth box again. So this requires a little bit of mental gymnastics. I hope everyone's paying attention. This is really important. Okay, so the angles that are implied by the common intersection, common price of labor, common rental for capital, will imply two different capital labor ratios. Those can be reflected into the Edgeworth box and define a parallelogram. Okay, because you have two different regions, you have Finland and you have Poland, and because they have the same production technology, they will have the same angles, common prices, common factor prices, common capital labor ratios in the two sectors, and these two angles reflected will form a parallelogram, and that parallelogram is the set of all capital labor endowments for which factor price equalization is possible. Okay, so any point outside of that parallelogram, factor price equalization doesn't work. Okay, so if you up here in this point, Finland is just too capital intensive compared to Poland. There's no trade that is possible that would eliminate the factor price differentials and would have to have some other adjustment we've discussed already, migration or capital mobility. Okay? And obviously what's going to matter is, if you like, the difference of those two angles. The bigger the difference is, the closer it is, you can actually do the whole thing in trigonometric terms. Okay? The larger that angle difference is, the difference between this one and this one, the greater the chances that factor price equalization can occur and achieve trade integration without having to have mobility of factors, capital and labor. All right, so that's the key idea. This is called the cone of incomplete specialization, and that parallelogram is called the factor price equalization set. Okay, so this is a common notion in trade theory. A lot of people don't take this very seriously, but in a regional context, you should take it seriously because the assumptions are more likely to hold. Common production technology. Now, of course, if capital is mobile and labor is mobile, you don't need this, but trade is the first thing that happens when you have an integration episode. And capital mobility next, and maybe labor mobility when people get, conquer all their fears and worries and pay the fixed cost income. So this is an extremely relevant result for our integration course. So the test will be, is E, the endowment point, again, thinking of Finland and Poland, even if Finland has a higher capital intensity in terms of its endowment, it still might pay for it to shift some of its resources into the sector that uses capital, its most intensively endowed factor, more intensely, and give some of the other industry to Poland. Okay, and we can actually use the diagram to find that. So look at point E, and look at the edge of the parallelogram. The edge of the parallelogram is defining, the sort of the borderline when it's no longer possible to do this. The factor price equalization can't take place, and there's no common factor price constellation that can actually solve the equation that we just wrote down. Okay? At point E, there's no incentive to move, so we can just stay there forever. We could actually just stay there. Finland could continuously export capital-intensive goods to Poland. Poland could continuously export labor-intensive goods. Workers have the same wage. Rates of return are the same. There's no reason for capital labor to move. So it's a type of specialization that is sustainable in the sense that I spoke of. It's a really important result. All the same, it's important to note that there is incomplete specialization as long as you're not at the edge of the parallelogram. So the edge of the parallelogram defines the limit, and at that limit there is complete specialization. So of at least one region. Okay, so again, if you're along this region, if you're on this edge here, you'd be this is Poland up in the upper. The Poles would be completely specialized in the production of cloth. Okay, but in general, it's not going to be a complete specialization. You're going to have a small share of your resource base, your endowment base, being used to produce that good which you are not advantageously endowed, in the sense that Poland will produce a few cars and Germany will produce a little bit of cloth. Even in a world where cloth and cars are completely homogeneous, not differentiable, not differentiated, and qualitatively the same. Okay, so it's really, it's a matter of because we're in a constant returns world, we don't know which firms are going to survive, but you're going to have some firms surviving in both sectors. This is why it's called incomplete specialization. It's not complete specialization. Okay, so the capital poor region will specialize in stuff, the labor-intensive stuff, and the capital-intensive region, Finland, will produce relatively more of the capital-intensive stuff. Okay? So you can actually trace that out. Again, before I go to the end of the lecture, let's take one more look at this and make sure we understand. This angle is translated into this angle. This angle is translated into this angle. Basically, those angles give the possible efficient uses of those resources, and some linear combination of those two will get us to any point inside that parallelogram. And as you can see, if you look very, very carefully at this, the angle of this little yellow segment is equal to this angle. Okay? These are parallel to each other. At least they're supposed to be drawn that way. That means that there will be a little bit of capital-intensive production in the labor-abundant region. And you can also think of the complement to that, which would be how much production you can. Effectively, it's like adding the two vectors that give the linear combination that gives us exactly the red point. Okay, so next time, this is a Punktlandung. I'm almost exactly at quarter of. Next time, we're going to talk about a bunch of variations on this theme. Okay, so we're going to talk more about Rybczynski, because the Rybczynski theorem has the implication that when factors are moved, production shifts. So the mobility of capital into Poland from Finland will cause structural change. This is an important point. Will cause structural change in Poland. It must, because Poland has to move resources from its stuff and into the auto production, right? Because of the Rybczynski theorem. So that means that some people will lose jobs and some people will gain jobs. Maybe it'll be a costless move, maybe it won't. At the same time, prices may change. If Poland has been isolated from the world market and the price of goods that are being discussed here change, that's going to change the rate of return on capital. It's going to change the wage paid to workers. We're going to discuss why countries often have resistance to joining the EU because they don't want that to happen. Okay, so obviously if you think the trade is going to lead to a reduction in the price of the good that you produce, and you use labor intensively, then the price of labor is going to fall, and workers are going to be very, very energized to resist the European Union accession. This is called the Stolper-Samuelson theorem. It's like the Rybczynski theorem. It has to do with the the relationship between output prices in an integrated economy and the price of the factors, the factor returns in the factor markets. We'll talk about the failures of trade integration. So sometimes this doesn't work. The implicit assumption was that Poland and Finland are trading both goods. What happens if you have a third good that's not traded? Lots of things like that. You know, haircuts, rental. You can't live in Poland if you're in Finland, right? You have to live in the place, you have to inhabit the apartment where you're living. There are certain non-traded goods that cannot be moved across borders, and that would lead possibly to a failure of trade integration. And if trade integration fails, then the other adjustment mechanisms have to kick in. Labor mobility, factor mobility as substitutes. I'd like to then apply the theory to the European integration episode and see what happens. There are lots of interesting episodes that we can think about, including dislocation of workers, unemployment, and sometimes resistance to what's being discussed. Okay. So, with that in mind, thank you for your attention. I'll see you next week.